Hey everyone, and welcome back to the AI Tech channel. Today, we're diving deep into Microsoft. Is it time to load up on Microsoft, or is a major correction looming? That's the million-dollar question after Microsoft's recent earnings release sparked a flurry of analyst activity. We're seeing price target adjustments all over the place, but the big debate boils down to one thing. Can Microsoft's AI dominance truly offset the potential hit from tariffs and a shaky global economy? Let's break it down. First, the news. Microsoft is riding high after reporting strong fiscal third-quarter earnings. Revenue jumped over 10% year-over-year, hitting $68.44 billion. Net income soared to $23.94 billion, or $3.21 per share. And the star of the show, Microsoft's Intelligent Cloud segment, including Azure, saw an impressive 18% growth, reaching $26.13 billion. These numbers are solid, no doubt about it. But the market is forward-looking, and that's where the analyst opinions start to diverge. Before the earnings report, all 20 analysts tracked by Visible Alpha had a buy or equivalent rating on Microsoft. The consensus price target was around $492, suggesting a potential 26% upside from the then-current price, near $390. However, post-earnings, many analysts have revised their targets, reflecting a more cautious outlook. Wedbush, for example, lowered their price target from $550 to $475, while Goldman Sachs adjusted theirs from $500 to $450. These aren't exactly bearish moves, but they signal growing concerns about the broader economic climate and the impact of potential tariffs. So what's driving the bullish sentiment? It's all about AI. Wedbush analysts, despite lowering their price target, remain long-term bullish on Microsoft, emphasizing the company's AI potential. They believe that the monetization opportunities around deploying AI in the cloud are transformational, and that Microsoft is in the driver's seat. Think about it. Azure is becoming the go-to platform for AI development, and Microsoft is aggressively integrating AI into its entire product suite, from Office 365 to Dynamics 365. This gives them a massive competitive advantage. Let's dig deeper into Azure. Its success isn't just about raw computing power. It's about the ecosystem Microsoft is building around it. They're offering developers a comprehensive suite of tools and services, including pre-trained AI models, machine learning platforms, and data analytics solutions. This makes it easier and faster for businesses to build and deploy AI-powered applications. And remember, the network effect is powerful. The more developers and businesses that use Azure, the more valuable it becomes. We are talking about a complete AI-driven ecosystem that is hard to compete with. Now, for the bearish counterargument. Goldman Sachs analysts, while still maintaining a buy rating, cited the current economic environment as a reason for lowering their price target. They acknowledge that Microsoft is well-positioned to capitalize on AI opportunities, but they also recognize the wide range of different outcomes that could impact the company's performance. This includes potential slowdowns in enterprise spending, increased competition, and, of course, the looming threat of tariffs. The tariff situation is particularly concerning. If President Trump's tariffs go into full effect, they could significantly increase the cost of Microsoft's hardware and software products, making them less competitive in the global market. This could lead to lower sales, reduced profit margins, and ultimately, a negative impact on the company's stock price. We've already seen other tech companies, like Apple and Amazon, feeling the pressure from tariffs, so it's not unreasonable to expect Microsoft to be affected as well. Interestingly, Morningstar analysts offer a slightly different perspective. They argue that Microsoft is in a stronger position than many other tech companies because it has minimal risk exposure to retail, advertising spending, cyclical hardware, or physical supply chains. This makes them more resilient to economic downturns and tariff-related disruptions. It's a valid point. Microsoft's business is largely driven by enterprise software and cloud services, which are generally less sensitive to consumer spending than, say, smartphones or apparel. And it's not just tech facing these challenges. Look at AbbVie, a biopharmaceutical firm. They reported strong earnings, but even they noted they could see an impact from potential tariffs on the pharmaceutical industry. This shows just how far-reaching these potential economic policies could be. Another potential challenge for Microsoft is increasing competition in the AI chip market. Reports suggest that Huawei is developing its own AI chip to compete with NVIDIA. While this may not directly impact Microsoft's software and cloud services, it could affect the overall AI landscape and potentially drive down prices, reducing Microsoft's pricing power. This is a rapidly evolving field, and Microsoft needs to stay ahead of the curve to maintain its competitive edge. The big question is, Can Microsoft's AI growth engine overcome these economic headwinds? It's a tough call. On one hand, the demand for AI is exploding, and Microsoft is perfectly positioned to capitalize on this trend. On the other hand, the global economy is facing significant challenges, and tariffs could create major disruptions. It's important to remember here that the macroeconomic environment plays a critical role. We're not just talking about Microsoft's internal performance, but also external factors that are largely outside of their control. This adds a layer of complexity to the investment decision. Consider Intel, for example. They're trying to grow their foundry business, but they're facing intense competition and significant operating losses. Even with potential partnerships with big tech firms, it's a long and challenging road ahead. This illustrates the difficulties that even established tech giants face in navigating the current economic landscape. And this is where the discussion of optionality comes into play. The potential for Microsoft to adapt and innovate in response to these challenges will be key to their long-term success. And speaking of innovation, look at MGM Resorts. Their BetMGM platform is seeing strong growth in online sports betting and iGaming. This shows that companies are finding new ways to generate revenue and adapt to changing consumer preferences. Microsoft needs to continue to innovate and explore new opportunities to stay ahead of the competition. It's also worth noting that IBM is planning to invest $150 billion in the U.S. over the next 5 years. This is a significant commitment to American jobs and manufacturing, and it could potentially create new opportunities for Microsoft as well. These kinds of large-scale investments can have a ripple effect throughout the economy, benefiting a wide range of companies. Despite the positive news from some companies, the S&P 500 and Dow are still down for the month. This highlights the overall uncertainty in the market and the challenges that investors are facing. It's important to stay informed and to carefully consider all the factors before making any investment decisions. Remember, diversification is key to managing risk. So what's the bottom line? Microsoft is a powerful company with a strong position in the AI market. However, it's not immune to economic headwinds and tariff-related disruptions. The key to its success will be its ability to continue innovating, adapting to changing market conditions, and navigating the complex global landscape. Investors need to carefully weigh the potential risks and rewards before making a decision about whether to invest in Microsoft stock. Let's bring in some expert opinion here. According to a recent paper published in the Journal of Artificial Intelligence Research, the future of AI monetization hinges on the development of robust explainable AI, XAI, techniques. This is crucial for building trust and adoption among businesses and consumers. Microsoft's investment in XAI will be a key differentiator in the long run. Furthermore, the success of Azure depends on its ability to offer federated learning capabilities, allowing businesses to train AI models on their own data without sharing sensitive information. This addresses privacy concerns and unlocks new opportunities for collaboration. The integration of quantum computing into Azure could also provide a significant competitive advantage, enabling the development of AI algorithms that are currently impossible to run on classical computers. These are the kinds of strategic investments that will determine Microsoft's long-term success in the AI arena. So is Microsoft a buy or a hold? That depends on your risk tolerance and investment horizon. If you're a long-term investor who believes in the power of AI, Microsoft could be a good addition to your portfolio. However, if you're concerned about short-term volatility and the potential impact of tariffs, you might want to wait for a better entry point. Ultimately, the decision is yours. But remember to do your own research and consult with a financial advisor before making any investment decisions. Remember that the market is dynamic, and the situation can change quickly. Stay informed, stay vigilant, and stay ahead of the curve. Looking ahead, keep an eye on a few key factors. First, monitor the progress of tariff negotiations and their potential impact on Microsoft's business. Second, track the company's AI initiatives and their ability to generate revenue. Third, watch for any signs of increased competition in the cloud and AI markets. And finally, pay attention to the overall economic climate and its potential impact on enterprise spending. By staying informed and vigilant, you can make more informed investment decisions and navigate the ever-changing world of technology and finance. And don't forget to check out our other videos for more in-depth analysis of the latest tech trends. Thanks for watching. What do you think? Is Microsoft's AI push enough to overcome tariff concerns? Let us know in the comments below. We want to hear your opinions and start a conversation. Also, don't forget to like this video and subscribe to our channel for more tech news and analysis. Click the bell icon to get notified when we release new content. And as always, thanks for watching.